Dirty dealings, corporate battles, consumer woes. This is Evening 5. The National Audit Department will be auditing 2,000 government-linked companies beginning next year in an effort to create a new era of enhanced governance in Malaysia, said Auditor General Datuk Wan Suraya Wan Muhammad Radzi. This initiative follows the approval for the Audit Act 1957 Amendment Bill in July, which significantly strengthens the AG's powers, thus enabling a more comprehensive oversight of public spending in Malaysia. She added that no entity will be left behind and that everybody will be audited during the first round. This will be followed by some screening to identify lower-risk entities, followed by a more detailed analysis to ensure the governance and accountability are continuously improved, Banama reported. She said that the NAD is embracing a new era of accountability and governance through innovative approaches, particularly in the integration of technology. She added that the auditors will also ensure that data collection is done properly within the parameters of the new technology while maintaining confidentiality. Through these efforts, the department seeks to enhance public trust in Malaysia's institutions by ensuring transparency and accountability in financial management. At the same time, she said that the NAD is embarking on a new chapter of governance with a shift towards thematic audits. She highlighted that after conducting its first thematic audit of the forestry segment last year, the department is now focusing on critical areas such as food security and sustainable development goals. Astro Malaysia Holdings posted a net profit of 54.7 million in the second quarter, its best quarterly result since the quarter ended January 2023, on the back of lower expenses and better finance costs on favourable foreign exchange impact. Quarterly net profit more than doubled year-on-year despite a 6% decline in revenue to 787.3 million due to lower subscription and advertising revenue. No dividend was declared for the quarter. Notably, finance costs dropped sharply to 10.8 million from 74.1 million in the same period last year. Similarly, for the first half, Astro's earnings rose 81.4% year-on-year to 71.7 million, while revenue slipped 8% to 1.56 billion ringgit. Finance costs for the period fell by nearly two-thirds to 67.3 million from 183 million ringgit. Average revenue per user for its pay TV services inched higher to 99 ringgit and 80 cent in the second quarter from 99 ringgit and 10 cent a year ago. Meanwhile, Astro said its broadband user base grew 11% year-on-year, while its over-the-top TV service Suka sees active monthly users of 1.3 million, with more paying customers amid popular events such as Euro 2024. Group CEO Ewan Smith said that the group is committed to growing its customer base, strengthening its adjacent businesses like Astro Fibre and Suka, and to better manage its costs. Kawan Food said it is closing its manufacturing facility in China due to the impact of US tariffs and limited room for expansion. The group, which produces food products like prata, flatbread and pastries, operates two manufacturing plants, one in Pulau Indah, Selangor and the other in China through wholly owned Kawan Food Nantong Co. In a boss filing, Kawan Food said the imposition of US tariffs on Chinese imports since 2018 had made it more competitive and efficient to export from the Pulau Indah factory. Apart from that, rapid urbanization in the region surrounding the KFN factory has limited opportunities for future expansion. The group said that the closure of KFN will not have significant financial impact as its sales contribution was less than 5% of the company's total, and the manufacturing operations have been underutilized since imposition of the tariffs. Following the closure of KFN in China, Kawan Food plans to expand the Pulau Indah factory by using equipment and machinery from the KFN facility, supplemented by investments in newer technology. The strategy is aimed at better serving the needs of the Chinese market and enhance its competitiveness in the domestic market as well as export markets including the US, Europe, Asia, Africa, the Middle East, Australia and New Zealand. Additionally, Kawan Food said it plans to realize the value of its land and buildings at the KFN site in China at a later date. The Malaysia Competition Commission's investigation found 81 enterprises allegedly involved in price-fixing agreement for the provision of Umrah travel services. A proposed decision was issued and the 81 enterprises face possible penalty for the breach of Section 4 of the Competition Act 2010. MyCC noted that the cartel behaviour allegedly stretched back to 2023. Chairman Datuk Sri Muhammad Hishamuddin Yunus said that it is important to highlight that at this stage, the proposed decision is a provisional finding and it should not be assumed that these enterprises have infringed the law known as Act 712. MyCC will then make a final decision on whether an infringement has been committed and disclose the penalty to be imposed. A firm can ask the Competition Appeal Tribunal to re-examine MyCC's decision, and the last avenue for appeal would be to initiate a judicial review. MyCC investigation provisionally found that the 81 enterprises, which are also the members of an association registered in Malaysia, have agreed to fix the floor prices for both economy and premium Umrah package services during their meetings in early 2023. GISB Travel and Tours, Abil Travel and Services, and Abu Rizki Travel and Tours are among the 81 enterprises identified by MyCC. Muhammad Hishamuddin added that MyCC will issue its final decision only after taking into account the representations made by the enterprises together with the evidence obtained during the investigation. Yinson Holdings' net profit fell 11.7% year-on-year to 203 million for its second quarter on the back of lower revenue and finance costs doubling. The oil and gas floating production storage and offloading or FPSO asset operator declared an interim single-tier dividend of 1 cent per share. Revenue dropped 31.2% to 2.14 billion from 3.11 billion previously, mainly due to lower contribution from its engineering, procurement, construction, installation and commissioning segment. For the first half, its net profit also declined by 7.3% to 406 million from 438 million as revenue shrank by 29% to 4.36 billion ringgit. On prospects, Yinson sees expansion in all business units, including clean energy production and solutions on top of its core FPSO projects. Yinson explained that the demand for FPSO is positive with the increase in project sanctions around the world, particularly from Brazil. The company also said the broader effect of elevated energy prices is the acceleration of the energy transition as more investments pour into developing renewable and alternative sources of energy. 3 FPSOs, Atlanta, Maricutera and Agogo, would commence their charter periods over the next couple of years.